Welcome to your market brief for the week of March 23rd. I'm Caroline Woods. The Dow and S&P 500 are coming off their worst weeks since 2008 as U.S. stocks got slammed once again last week. This week, investors, they're bracing for more volatility. Let's get right down to it with Sam Stovall. He's Chief Investment Strategist with CFRA Research. Sam and I recently unpacked his outlook for stocks in 2020 with historical perspective from previous bear markets. Watch this.
We hit the 20% decline threshold in only 22 calendar days, more than twice as quickly as the next fast bear market. So when you think historically that we end up with a swift decline, they have usually been shallow declines. But it appears based on GDP forecasts for the second quarter, which we think will be down at least 5%, it might not be as swift as or shallow as we think. If we look to projected earnings growth, well, actually, history tells us that during recessions, the S&P has seen earnings fall by 10%. Seeing that amount of a decline and then applying a multiple of 10 times forward earnings, as we saw back in 2008, that would imply that we're going to see a bear market that rivals what we saw in 07 through 09. And if we then use that bear market as a guide for how long it takes to get back to break even, be prepared to wait 4 years before your portfolio is whole once again.
So 4 years, not awful for the longer term investor, but I mean, I guess how much further can we fall from here? And are you tempted to buy it all at these levels?
Well, we're down more than 30% right now. We just broke below the line in the sand drawn by the December 24th, 2018 low. So it seems as if we could end up with quite a bit more to the downside. So what am I doing with my portfolios? First off, I am resisting emotional temptation to sell at these low levels because historically, people might know when to get out, but they don't really know when to get back in. And when they do, it's usually higher at a level than where they got out. Second, I like to focus on income-oriented investments. So I focus on those companies that are offering very tempting yields, 6%, 7%, 8%, but also realizing that they might be cut. So I look for those companies whose consistency of raising earnings and dividends has been well above average, as replicated or seen in the S&P quality ranking, a letter grade of A-, A, or A+ for stocks in the S&P 500.
That was Sam Stovall with CFRA Research. Shifting to a preview of the week ahead on the earnings calendar this week, major companies include Nike on Tuesday, Micron on Wednesday, and then on Thursday, we'll hear from both Lululemon and GameStop. GameStop came under fire recently after asking some of its employees to continue working in stores, noting that its goods could be considered essential retail. So we'll see if management addresses this issue any further on the conference call with analysts this week. Now in Washington, we're also awaiting the latest developments for a coronavirus stimulus package after the rescue bill failed in a key procedural vote in the Senate on Sunday night. The Fed announced a major expansion of its lending programs designed to aid the credit markets. It expanded its facilities to include certain types of corporate and municipal debt and said its purchases of treasuries and mortgage securities will essentially be unlimited. On the economic calendar this week, we'll get housing and durable goods data for February from the Census Bureau. The Bank of England announces its policy rate decision on Thursday. And additionally, we'll get the third and final estimate of U.S. GDP in the fourth quarter of last year, which of course does not include the impact of the coronavirus. This will likely be the last positive quarter for some time, as we'll undoubtedly see the steep economic impact of the virus in Q1. With that, we'll also get weekly jobless claims, which will offer a more accurate indication of the employment picture across the nation. All right, shifting back to U.S. markets, I'm joined now by Alan Patricof. He is co-founder and managing director of Greycroft. He joins me via Skype. Alan, great to have you with us.
Great to be here early in the morning.
All right, I want to ask you, because I heard you say that you thought that the latest market downturn was a blip and that you hadn't sold any stock. It's been a few weeks now, so I wanted to check in about that. Is that still the case?
Well, maybe I shouldn't have used the word blip. What I meant to say, and I'm not changing my position, is that market declines like this. Now, this one has been catastrophic. I have to say, no one could have anticipated how deep it would be. But I've been through 74, 87. I can go through the list. We all know more recently, 2001, 2008. And the market comes back. There was a great cover story in the New York Times about 2 weeks ago when it showed the last 10 years and all the blips that have taken place. Blip, I'll use the word again. But that the long-term trend has been positive. And I think we have to look at this as a setback, certainly a very dramatic one. But my point was, don't panic, don't sell into this. If you're a long-term holder, let it serve as a quote blip in a long-term cycle, and that if you're in this as a 401k or your savings, that sit tight and if you, as long as you have a time perspective and as long as you have the capital to withstand a dramatic decline in this case.
So sit tight. So you're not selling, but what about buying? Are you using this as a buying opportunity at all? What is your advice for those longer term investors who are looking to dip their toes back in? I mean, what should they even be looking for in a stock right now?
Well, I would say this is first of all, I would be investing on a regular basis whether you're doing it monthly or quarterly or whatever. Keep up that kind of consistency, so then you will end up with some kind of form of dollar averaging for the average investor. Other than that, I always have taken the position that if you know a company and the stock declines in a dramatic fashion, you should, as an old mentor of mine said, if it goes down in 50%, you should like it twice as much. So I think if you look at companies that have fundamental values that you think are going to come through this and withstand this decline, that have the cash, have the capital structure, and have a basic fundamental business with basic economics, that it's a great opportunity to increase your position. Of course, you always have the opportunity of selling and coming back in 30 days so you don't violate the wash rules. But I think that's another alternative. But I think you shouldn't be out of the market. You're required to be out for 30 days under the rules. But I think you want to be in great companies. You want to stick with them. You don't want to get faked out, so to speak, and get out of position. Now, in terms of the venture business, which is where I focus my efforts, the weak companies are going to fall to the wayside. I mean, I've been sending out messages to my company. I think a lot of people certainly have, is make sure you have enough cash to sustain this decline. Don't sit around and study the problem for the next 2 or 3 weeks. Every day for a young company is important in terms of its cash reserves. So I would say take quick action.
All right, we have to leave it there. Alan, really appreciate your insights. Thanks so much for joining us.
Thank you.
That concludes today's Market Brief. I'm Caroline Woods. As always, thank you so much for watching. Stay safe and healthy, and we'll see you next week.